Good morning. I'm Jerry Sagona, Vice President of Business Development with the Rockford Area Economic Development Council. Today we present a webinar on understanding the Main Street Lending Program with the law firm of Hinshaw Culbertson. The Rockford Area Economic Development Council is hosting these webinars as a service to our community to provide meaningful information to help businesses reopen and prosper during this pandemic. Please visit our website at www.rockfordil.com. for other business resources. There will be 2 more webinars scheduled during the month of July. On July 23rd, the ED Talk series returns with Rockford University and continues with a presentation on situational leadership. Learn how to flex your leadership style to develop and motivate your employees. On July 30th, we'll have a webinar with IMEC, the Illinois Manufacturing Excellence Center, on database mining, sales, and customer service. Again, please visit our website for the dates and registration details. Before we begin, I would like to give recognition to today's webinar coordinator, Anna Garrison, Manager of Projects and Events with the Rockford Area Economic Development Council. I mention this because there's a tremendous amount of effort required behind the scenes to coordinate a webinar. Thanks, Anna. So let's get the ball rolling. Today's webinar is scheduled for approximately 1 hour with the last 15 to 20 minutes reserved for questions and answers. Please feel welcome to submit questions throughout the presentation through the question chat function feature on your screen. This morning, I would like to welcome attorneys TJ Leek and Timothy Sullivan with the law firm of Hinshaw Culbertson. TJ concentrates his practice in the areas of business transactions and estate and financial planning. TJ has been involved in advising corporations, associations, and not-for-profit corporate entities on various corporate formation matters, mergers, acquisitions, government issues. He also advises clients regarding estate planning and administration matters. In addition, TJ focuses his practice on advising closely held and family businesses on ownership relations and succession planning issues. He is active in the pro bono program at Hinshaw Culbertson, assisting various charitable organizations in all aspects of corporate matters. Timothy Sullivan is an experienced transactional lawyer. He has orchestrated a number of mergers and acquisitions, handling all aspects of compliance with federal and state securities laws and regulations, as well as issues relating to ISRA, tax, labor, and environmental matters. Mr. Sullivan is a past leader of Hinshaw Culbertson's National Commercial Transactions Practice Group. I'd now like to turn over the presentation to TJ.
Thank you, Jerry. Again, I wanted to extend my welcome to everybody on the webinar. It's our pleasure here at Hinshaw to partner with RAEDC to put these on. We believe we can provide a lot of good information and content for all of you listeners out there. This is a seminar that is kind of a subsequent or a follow-up to our May 27th seminar, which you can actually find on the RAEDC website or on Hinshaw and Culbertson's website, related to various financing opportunities for businesses affected through COVID. And the May 27th focused on the Paycheck Protection Program. In that program, we had mentioned another program, this Main Street Lending Program, that had been announced, but there had been no rollout and no rules or regulations or anything issued at that point. So we wanted to take this seminar to go through a lot of that, and that's what my partner, Tim Sullivan, will be doing shortly. But before we do that, I did want to give a little bit of update on the Paycheck Protection Program itself from our May 27th earlier presentation. Next slide, please. So that May 27th presentation, we had mentioned that there was probably going to be more updates and revisions to the PPP program, and sure enough, the following week there was a new law that was signed in, and that was the Paycheck Protection Program Flexibility Act. And similar to the original act, once that was done, there was new guidance issued and interim final rules issued shortly thereafter. A lot of commentary going on about a lot of those provisions. I'm just going to run through them relatively quickly today, so then we can get through to Tim's Main Street Lending Program. I just do also want to point out there's likely to have more guidance and more rules and more legislation actually even passed. Right now, pending in the Senate is another bill that would allow for automatic forgiveness for any PPP loans that were under 150,000. Now that hasn't been signed or anything, but similar to how it's always been done, there's more to come on the PPP program. Next slide, please. So what did the Paycheck Protection Program Flexibility Act do? I've put together on this slide a bunch of bullet points of what it's been done. You can read through this at your leisure. But the big things I wanted to point out is that the 8-week original period has been extended to up to 24 weeks. But even if you decide you want to use that, you can file for forgiveness before the end of the 24-week period. Our advice to clients is always just to make sure that when you get ready to do that filing for forgiveness, that you will maximize the amount of forgiveness that you can do. And that is a calculation and a test that you'll have to work through. And that the rest of these points are really kind of focused in on how to maximize that forgiveness. So again, there's the safe harbor for hiring back employees that was extended to December 31st, the end of the year. But there are a lot of restrictions there. I would want to point out that if you try to hire somebody back and they turn down that employment, you do have to report that to the local unemployment office in the state that you're in Illinois. That would be the Illinois Department of Employment Security. So there's that. They've also extended the maturity term to 5 years, and even if you received your loan before June 5th, you and the lender could mutually agree to extend it to the 5 years. Again, there was a change from the 75-25 of 75% employment expenditures versus 25% of other qualified expenditures, including mortgage and utilities. That's changed to now 60-40 to allow for more flexibility on that. Compensation caps were extended from the 8-week to the 24-week period. So that goes from approximately 15,000 to approximately 46,000. And then as part of all this, there was 2 application for forgiveness forms that were issued, the standard form and the EZ form. In order to really qualify for the EZ form, you're probably going to have to go through all of the calculations as if you were doing the standard form to find out if you were to qualify. So there's going to be a lot of work dealing with those forgiveness periods of when to file to maximize the amount of forgiveness and which forms you are to file. So that's kind of the Paycheck Protection Program flexibility in a nutshell. Next slide, please. And I guess I can always just put in one other change that was done is that the deadline to apply, if you still haven't applied and want to get a Paycheck Protection Program loan, that date was extended from June 30th to now August 8th. And there's still plenty of money available in the program. So if you're interested, you can still do that. And again, we won't focus on the actual applications or anything on this seminar at this point. So that's it. That's my quick update on the PPP program. And without further ado, I'll turn it over to my colleague, Tim Sullivan. He can discuss the Main Street Lending Program and the applications and rules and restrictions. Tim, take it away.
Next slide, please. Thanks, TJ. Again, I'd like to extend my thanks to the Development Council for allowing us to participate in the program today. We've been doing a lot of work in this area, both on the Paycheck Protection and on the Main Street Lending. As you can see, the Main Street Lending Program finally launched on July 6, 2020. It was not an easy launch. There were over 3 major releases by the Fed trying to get its arms around the program. In addition, there were over 2,000 comments received in the various aspects of the program. So it took a lot of work to get us to where we are today. While the first Fed material came out in late April, and again in May, the Fed told banks to start getting ready to process loan applications as best they could, and that once the program launched, they could now then forward those loans, completed loan applications to the Fed for approval, and the loans could be funded. So that process started July 6th. Under the Main Street program, there's 3 facilities: the Main Street New Loan Facility, the Main Street Priority Facility, and the Expanded Loan Facility. Basically, what will happen is the Federal Reserve Bank of Boston will set up a special purpose vehicle it will lend up to $600 million to that vehicle, and then that vehicle will buy 95% participations in eligible loans issued by eligible lenders. This is all being run through the Federal Reserve Bank of Boston. They have a whole program on their website with copies of the agreements, a list of lenders and things like this. So it's bostonfed.org. If you're looking for a place to go for a resource, that's where most of the materials can be found. They noted there at the bottom, the board, Federal Reserve Board, has the ability to expand the program. They are considering right now whether or not for-profits should participate in the program. They haven't made a decision. They issued comments, requests for comments on that concept a few weeks back, and have still not made a decision. Just yesterday, they approved the tribal businesses to participate in the program. So again, the Fed is looking at this as something that they may expand the availability of the program. Next slide, please. They say there's a composite little table that'll show you the three different loan facilities. Basically, the new loans and the priority loans, the minimum is $250. On the expanded loan facility, the minimum is $10 million. And then you can go through, then we'll go through all of these criteria as we get further into the program. But it sort of gives you a quick snapshot of what the various terms are, and also shows from the changes that were made from the last reiteration of this program. Next slide, please. As you'll see, the loans are full recourse and are not forgivable, unlike the Paycheck Protection Program. In addition, as I said, there's three possible facilities available under this program. A borrower may participate in one of those facilities. It cannot participate in more than one. In addition, the only entities participating at this point as eligible lenders are listed there. Basically, your U.S. Banks and Savings and Loans Association are eligible to participate in the program, although the Fed has said they're looking at possibly adding non-bank lenders to the program, but that hasn't happened yet. One of the things, and I guess one of the concerns about this with the eligible lender issue, is that at this point in time, as best as I can tell, only 450 banks have indicated an interest in participating in the program. For a bank to participate in the program, it has to go to the Federal Reserve Bank of Boston and register with the program. 450 have so far. That's out of approximately 5,000 banks in the United States. So the interest on the banking part, on the bankers' part, doesn't seem to be that great at this point in time. Hopefully, as the program rolls forward, that'll increase. Another thing you can do when you register on the Boston Reserve site, the lender can hit a button and say they'd like to let people know that they're interested in not only participating in the program, but in bringing in new customers to the program. So that, and there's a map there at the website, you hit the map of the state of Illinois, and it'll give you a list of the banks that are looking for new customers to participate in the program. Again, indicating some lack of interest on the bankers' part. There's only 7 banks in Illinois that have signed up for that feature, and only 6 banks in Wisconsin so far. But like I said, hopefully that'll change as time progresses. Next slide, please. This is basically a listing of what an eligible borrower must have in order to be able to participate in the program. Established and operating prior to March 13th, 2020. It is not an ineligible business. We'll get into that shortly. It has to have either 15,000 or fewer employees, or 2019 revenues of $5 billion or less. That's an either/or test. They can meet either one of those, and they qualify for the program. Must be organized in the U.S. or under the laws of the United States, with significant operations in the U.S. And again, so that sort of question of whether or not foreign subsidiaries can participate in the program Fed has some guidance on that at this point in time. Again, as I mentioned previously, there's 3 facilities available here. An eligible borrower can only participate in one of the facilities, and however, they can get more than one loan in the same facility. As I mentioned, the new loan facility, the maximum loan there is $25 million. But if a borrower comes in and borrows $10 million and still has some borrowing capacity left, borrower can get a second loan through that facility. The last point on the page there, that a borrower does not receive specific support pursuant to Subtitle A. Really what that is part of the CARES Act, the government set up various funds to help specific industries like the airlines. So if you're in the airline industry and you're receiving funds from the government under that program, you cannot participate in the Main Street Lending Program. Next slide, please. As you'll see there at the top, a business that has received the PPP loan or an economic injury disaster loan can participate in the program. However, one of the tests in the program is how much debt you have as currently as to how much you can borrow, and the PPP loan amount is included in that when you do that test on that. A brief definition of what a business is, it won't go into that, but you go to the next portion of that, you'll see there's 3 facilities prohibit an ineligible business from participating in the program, and they rely on the SBA rules as modified through the PPP program for ineligible businesses. So there's about 15 or 20 businesses that are not eligible to participate in this program. You really need to go to the SBA website and the site I have there to go through that list to see if your particular business is not permitted to participate in the Main Street Lending Program. This is a requirement. The burden on this falls on the borrower. The lender is not obligated to do this checking. The borrower has to do the checking and certify. So for example, one of the businesses that cannot participate in the Main Street Lending is the cannabis industry. Cannabis is still illegal in the United States, although a number of states have authorized its use. Because it's illegal under federal law, it's an eligible business under this program and cannot participate in this Main Street Lending Program and could not participate in the PPP program. As you'll see there at the bottom, private equity funds are ineligible businesses, but a private equity fund usually owns a number of different businesses, and those underlying businesses might be able to participate in the program. The next slide, please. This slide just gets into is one of the tests is you have to have fewer than 15,000 employees. This slide sort of walks you through the SBA rules. Again, it's the SBA rules on counting employees, just like with the PPP program. You count everybody, you count part-time people, seasonal employees, but you exclude volunteers and independent contractors as employees. So there's a test where you're trying to see whether or not you reach the 15,000 threshold. You have to follow the SBA rules on that. The same thing is with respect to the second part of the test, which is the $5 billion or less in revenues. Again, you have to use the SBA formulation and its rules as to how you count the revenues. Affiliated companies, and the SBA has a whole set of rules on that as to how whether or not a company is affiliated. Affiliated companies also count when you're doing your revenue calculation. So you have to look at that and make sure that you either have fewer than 15,000 employees or you have less than $5 billion in revenue for 2019. Next slide, please. As part of the process, both the lender and the borrower are required to make certain certifications when they file the materials with the Federal Reserve in Boston. And you'll see there's a list of the 4 certifications that the lender has to provide. As you can see, the lender's committing that it will not request the borrower to repay debt extended by the eligible lender unless there's a default or unless the debt and interest are mandatorily due. That's interpreted as meaning if you have a loan agreement that basically says interest payments are due on the first of every quarter and we have principal payments scheduled, that's already in the contract and that's deemed to be a mandatory payment, so you can work around that. But those certifications have to be made by the lender. Next slide, please. And these are the borrower certifications. Again, the number of things that the borrower has to certify. I think the most important one, and we ran into this in the PPP loan program in terms of there was a question of whether or not borrowers really needed the funds under the PPP program. This certification is that the borrower has reasonable basis to believe that after giving effect to the loan, it has the ability to meet its financial obligations for at least the next 90 days. So it's a certification again from the borrower that it has the ability to go forward if it receives the funds and it's not expecting to go into bankruptcy. Clearly, going back to the eligible businesses question again, a company in bankruptcy is not eligible to participate in this program under the SBA rules. Go to the next slide, please. These are a few more of the covenants. The one at the top of the page, this is for the borrower. Again, this is where it's been difficult for some borrowers to move forward on the concept here. As you'll see, there's compensation limitations, stock repurchase limitations, and capital distribution restrictions that apply to companies that participate in the program. And basically, these restrictions apply for the entire time the loan is in existence and for a 12-month period after the loan is paid off. I will go into this in a little more detail when we get to the tail end of the program. We'll have a little more discussion on those, which you'll get an idea of what the borrowers are facing and dealing with at this point in time. The lender has to collect the certifications. In addition to these certifications, there's a whole list of other certifications that a borrower has to make to the government when it applies for a loan. You'll see the one at the bottom of the page there for example, the borrower must certify that is unable to secure adequate credit accommodations from other banking institutions. That doesn't mean that the borrower has to be shut out totally from getting loans anyplace else. It just means that the borrower has to be able to certify that, for example, it couldn't get a loan on the terms that were reasonable for it. The mainstream lending program rate is LIBOR plus 3%. So if a borrower is getting LIBOR plus 5 or 6 or 7, they can take the position that they can meet this certification because the loans being offered are not acceptable to it on those terms. Go to the next slide, please. One of the terms for a lender reviewing a situation with a borrower, if the borrower already has loans outstanding with the lender, as of December 31st, 2019, such loan must have received a pass rating. So in other words, if I'm a lender going to a borrower who's looking to take on a Main Street loan facility, that my existing credit with the lender must be in good stead as of December 31st, 2019. Next slide, please. You'll see there that these loan participations, as I said at the start, basically what happens is the lender files the loan application with the government approves the loan. At that point in time, the loan is funded, and immediately thereafter, the lender sells a 95% interest in the loan to the special purpose vehicle. And that's how all three of the different facilities work in this situation, so that the risk of the loss on the loan switches from the lender to the government, because the government's going to own 95% of the loan. So that's the, if you will, for a benefit for the lender that's looking to accommodate customers but isn't willing to assume a whole lot of risk. It'll sell a participation to the government and move that risk off, unfortunately, to the taxpayers if there are problems in the future. Next slide, please. There's a transaction fee is assessed at the time the loan is booked with the government. There's a 75 basis point principal amount of the loan for an expanded loan facility, and 100 basis points for a new or priority facility have to be paid by the lender to the special purpose vehicle. However, the lender can charge that fee to the eligible borrower. In addition, the borrower has to pay an origination fee to the lender of 100 basis points for a new or priority facility loan, or 75 basis points for an expanded facility loan. And just the expanded facility loan, just to use that concept a few times here, what that means is I'm a lender, I have a borrower who already has a credit with me. The borrower wants to borrow additional money. What the expanded loan facility does is that new loan is stacked on top of the existing loan. That's the expanded loan facility, and both the old loan and the new loan sort of run together with same priorities and everything else. Is the new loan has the same priorities as the old loan. So that's what an expanded facility loan is. Those loans minimum are $10 million, and maximum is $300 million. I'll get into a little more detail on those loans in a few minutes. Next slide, please. A servicing fee. The lender will service the loan on behalf of the special purpose vehicle, and it receives a 25 basis point fee on a yearly basis for providing that servicing too. So basically the lending bank, although the majority, the 95% of the loan has been sold to the special purpose vehicle, The lending bank will still be the face of the loan with the customer. The lending bank will be making the collections, sending out the bills and notices, securing the financial reports and other items that the borrower has to provide on a regular basis, making sure the borrower is in compliance with the covenants of the loan and things like this. So the lending bank will, like I said, will remain the face of the with the borrower on this transaction. Next slide, please. One of the conditions of receiving a loan is that the borrower has to make a good faith effort to maintain and retain employees. It's not a requirement, it's just a good faith effort. The borrower has to look at its own situation, and if it needs to cut salaries or lay employees off because of a dire circumstances, it can do so. It's not, there's no requirement that a borrower has to maintain its workforce or maintain its payroll as it currently is. Something that is a different issue with the PPP loan program. But in addition, borrowers have already laid people off or furloughed workers are eligible to participate in the facility loan. So there's sort of a good faith effort on the part of the borrower to continue employees and payroll, but it's not a requirement. It's not a default if the borrower is unable to do that. Next slide, please. At the current time, as I said, July 6th was the opening date for the program. The board and the Department of Treasury expect to shut the program down in terms of purchasing loans as of September 30th, 2020. They have the authority to extend it, but at this point in time, they've announced that September 30th is the termination date for purchasing. They will obviously continue with whatever obligations they've incurred in the loans that they've purchased prior to that date, but that's the termination date right now. Next slide, please. I'd like to go into just a little off the slide here, what I've been doing over the last 2 or 3 weeks, aside from working on the program itself. I've been talking to lending clients, trying to get a feel from lenders, trying to get a feel from them where they are in this process, and try to sort of compile sort of a pros and cons of thoughts of different things as I went through. From a lender perspective, as I mentioned previously, this is a good deal because 95% of the risk is transferred to the government. The lender also receives a servicing fee, and in addition, an opportunity to acquire new customers or to provide a service to existing customers. The problem with the lender, for the lender's perspective, is there's a significant documentation required here. There's a loan agreement, there's a servicing agreement, there's a participation agreement, and a lot of the documentation. That makes it difficult for a lender that's interested in making small loans, maybe 500,000, maybe $1 million, in terms of being able to justify the expense of pulling that whole thing together and then making the loan. So unless you have a high volume at the low end of the lending scale, it's be difficult for a lender to justify that cost to put all that together. And then, of course, you do your loan package, you get it all together, and then the government can reject the loan if it determines to do so. To give you an example of some of the difficulties the lenders are dealing with, we have a client that recently sent us their memo on how to prepare the loan documents for transactions they referred to us to document for them. The memo was 10 pages long, single spaced, of instructions on how to prepare the loan documents. So you can see the complexity of the loan arrangement that make it difficult for some smaller lenders to participate in the program. In addition, concern from the lender's perspective and talking with them is, first, there's under the program on all 3 loan facilities, no interest is paid the first year on the loan. Interest is capitalized, but no interest is paid. In addition, no principal payments are required for the first 2 years of the loan. At the end of the 3rd year, 15% principal reduction is required. The same reduction at the end of the 4th year, with a balloon at the end of the 5th year at 70%. That presents a problem for lenders in terms of we get to the end of the 5th year and the borrower doesn't have the ability to pay off the balloon payment. Do we default them and go after the collateral? Do we refinance? And so lenders are looking at that on the horizon in terms of what is the best way to go here. So I think those are some of the concerns about that the lenders have in this area. One other thing we've seen in conversations with the lenders, a lot of the smaller lenders with maybe banks with assets of $1 billion or less, I've talked with some of my clients in this area, and they basically said they don't have a whole lot of demand at this point for the product. A lot of their demand was taken care of by the PPP program. So they've issued several $1 million of loans to their local small business customers, and they feel that the business customers are happy with that. And there's not a whole lot of demand for that. At the next level, as you get to the bigger banks, one of the concerns is that the bank has to underwrite the loan in terms of doing its due diligence on the borrower. If the borrower is in really good financial condition, there's probably no reason for the borrower to participate in the program because it doesn't need to live with all of these restrictions, and some of which we'll get into shortly. On the other hand, if the borrower is not in good shape, it can't participate in the program. I call this sort of like the Goldilocks effect. If you're in really good shape, you can't. There's no sense to participate, and if you're in really bad shape, you can't participate. So that's again what the lenders are looking at in terms of, should I dive into this transactions and start doing this? Is there really going to be enough demand? I think that's one of the reasons why you see, as I mentioned previously, only 450 lenders have signed up so far, and only 7 in the state of Illinois have signed up, indicating they're willing to take on new customers. From the borrower's perspective, the pros here are obviously no interest for the first year, the balloon payments, as I discussed, over the 5-year period. So that's good for them in terms of managing cash flow and trying to get out from behind things. The cons for a borrower, as we'll discuss shortly, restrictions on dividends, restrictions on compensation are part of these. In addition, borrowers are limited under a formula for each of the loan facilities as to how much they can borrow, and that may, depending on where the company is with its balance sheet, it may not be in a position to borrow enough money to make any sense to participate in the program. In addition, they're paying an origination fee of up to 100 basis points when the loan is made. In addition, and as I mentioned, the lender pays a fee to the special purpose vehicle of up to 100 basis points, and the lender can charge that fee to the borrower. So the borrower on the front end is going to probably have 200 basis points of fees to pay, plus all the documentation fees. If there's appraisal, legal fees, UCC searches, that's all going to be on the borrower. The rules do allow, however, for those proceeds of the loan to be used to pay those expenses. So the borrower will net out of that, but it's still, from a borrower's perspective, a lot of money up front to get the loan off the ground. The last thing, or the last two things really on this, but this applies to both the lenders and the borrowers. The Fed is going to release on a monthly basis the names of the lenders and the names of the borrowers and the amounts of the loan. As you recall, recently we had they released that information with respect to the PPP loans. That generated a lot of news stories over various people who received the loans. And so you're going to have, as a borrower, it's going to be in the local paper that you went out and borrowed money under this program. Is that a reputational risk to you? Lenders' names are going to be in there, and that's lenders have to be concerned about that. And the last thing in that area, as we've seen with the PPP program, this, as Yogi Bear said, it ain't over till it's over, and we still may have more rule changes. The problem you run into, you're in the middle of a transaction and the government announces a rule change on this, or as happened in the TARP program back in the 2007, 8, and 9, the government did all these things, then it changed its mind after everybody had jumped in. So you've got that risk. We'll see some of this with the PPP program when they start doing audits of some of those loans, and they're going to audit all loans over $2 million. So there's going to be some issues there too for borrowers who may regret having gotten in the program. So those are the pros and cons of being in the program. We have the next slide, please. This is for the new facility loan. These are brand new loans for for borrower. The terms are listed there. Can you back up one slide, please? Yeah, there it is. Those are the terms that the new facility loan has to have. It's the 5-year maturity, the deferral of interest, deferral of principal payments. Excuse me, LIBOR plus 300 basis points. The crucial one here is the number 6 as to how much that you can borrow under a new facility. It's $35 million, or the amount that added to the eligible borrower's outstanding indebtedness is an undrawn available debt. Does not exceed 4 times the EBITDA. So what that means, if in 2019 a borrower had an EBITDA of $4 million it can borrow up to 16 million under the program. However, if the borrower already has $5 or $6 or $7 million worth of debt outstanding elsewhere, that amount is subtracted from the amount that the borrower might be eligible to receive. So if you have a $16 million loan possibility with $6 million worth of debt already outstanding, your limit is at 10 million on that transaction. Next slide, please. And that concept is true for all the two other facilities. It's the same thing. There's a limit on how much you can borrow based upon your EBITDA plus based upon how much outstanding debt you have. This is the loan processing procedures. As I mentioned previously, the lender has to underwrite the loan and has to decide that the borrower is in satisfactory condition under the lender's terms on how it would make a loan to anybody else. So again, we get back into the circular thing. If the borrower is qualified to receive a loan under this program, it'd be just probably easier for the bank just to make the loan directly rather than dragging the borrower into this program. But that's the procedures that the bank has to follow in terms of before it passes the loan out of the government for purchase. Next slide, please. You'll see there at the top of the page, that's just an instruction on how to calculate the EBITDA for 2019. The next paragraph there, as I said, the amount of the loan that you can get is the EBITDA multiplied, and then you subtract from that existing outstanding and undrawn available debt. And so that basically covers anything you have except those items that are excluded there under the bullet points under that. I would note that the last bullet point, unforgiven portion of a PPP loan, that has been changed. That's no longer available. The Fed has released they started with a 19-page FAQ on this program, and they're now up to over 80 pages. And so on almost a daily basis, you have to go back in and check and see what they've changed. So that last item there, unforgiven portion of a PPP loan, that is no longer available under the Fed, under the rules. They just issued a new update on July 15th that got us up to 65 pages of questions and 15 pages of appendixes, which sort of let out the terms and conditions that have to be in the loan documentation. So that's where that goes. Next slide, please. This is the expanded facility loan. As I mentioned previously, this is a transaction where the borrower has the loan already with the bank and needs additional funding. And that loan was issued on or before April 24th, 2020. The new loan will sit on top of the old loan. They work together, same term, the 5-year term, the LIBOR rate and things like this will apply only to the new loan that sits on top of the old loan. But basically, if you enter into expanded loan facility loan, the lender has to stay in the deal until both the upsized portion is paid off and then also until the underlying debt is also paid off. But again, it's the 5-year maturity, deferral of interest, deferral of principal payments, and the EBITDA concept there is the undrawn debt up to minus from six times EBITDA. So again, if your EBITDA is $15 million, you get up to $90 million loan, and then you start subtracting any debt you might have outstanding in other places in order to figure out how much of a loan you can get under the expanded facility. Next slide, please. Then we can go to the next slide from here too, please. This is a priority facility loan. It's similar to a new facility loan. The only difference is that the amount of the loan that you can get under this program is much higher. It's $50 million, and the EBITDA calculation is 6 times EBITDA rather than 4 times EBITDA. And the benefit of the priority facility loan, and again, talking with lenders as to how they were going to approach this, that you can use this is the only loan that you can use to pay off other debt. So if you go to your bank and you want a priority facility loan, you can borrow there and you can use that funds to pay off other debt, but it has to be debt with another lender. So if you're borrowing from bank A, you get a priority facility loan, you want to pay off debt, you can pay off debt at bank B, but you can't use it to pay off debt at Bank A. But again, if you're a lender looking to branch out its businesses, this is a good way to go in, offer customers an opportunity to move into this program and to have their old loans paid off at the other bank. That's from talking with the lenders, that seems to be the best part of this program from their perspective in terms of attracting new customers. But again, it's the same criteria. You have to underwrite the loan. You have to be satisfied that the customer is good for it, and you have to comply with all the other terms and provisions of the loan. So still the same issue. Next slide, please. And you'll see there at the bottom of the page there makes reference to using the proceeds to pay off another loan from another lender. Next slide, please. Right. On the certifications from the borrower that we discussed previously, the borrower has to comply with this particular certification and other certifications. So this goes to the first point there is that the borrower cannot repurchase equity securities that are listed on national securities of its own. So if a borrower is a public company, it can't, from the time the loan is made until 12 months after the loan has been paid off, it cannot go out into the marketplace and purchase its own securities. Now, for a privately listed company, that doesn't make any difference. They're not traded on a national securities exchange, so that won't bar them from doing that. But for a public company, this is a limitation on their ability to repurchase their own shares. The next requirement is that, again, for the life of the loan plus 12 months thereafter, the borrower cannot pay dividends or make other capital distributions with respect to its common stock. You'll see there's an exception for S corporations and other pass-through entities, but for assuming the loan goes to maturity, so you're talking a 6-year period that the borrower will not be able to pay dividends. That's could be a problem for quite a few people. The last point there is that the borrower must comply with the compensation limitations set forth in section 404. We go to the next slide, please. Section 404 basically puts restrictions on high salaried individuals. The first test, if the individual, and this runs for the life of the loan plus 12 months after the loan is over. If an individual received more than $425,000 from its company in 2019, he cannot receive in any 12-month period compensation that exceeds $425,000. So when you look at this realistically, that's what that's saying is any officer over receiving more than $425,000 is going to be in for a pay freeze for 6 years. That's the only way to interpret that. They can receive severance if they are terminated, so your golden parachute, but that's limited to twice the amount of the maximum compensation received in 2019. So then that caps that off. If an employee has a golden parachute agreement, those usually, as the salary increases, the amount of the payment increases. But this locks the golden parachute in at 2 times what was received in 2019. The second test is with respect to anyone making more than $3 million a year, and again, for the next 6 years, they cannot receive during any 12 consecutive month period compensation in excess of the sum of $3 million plus 50% of what it received in excess of $3 million in 2019. So again, if an officer received $5 million in 2019, it effectively receives an automatic pay cut to $4 million for 2020, and that again is in effect for 6 years without a pay raise. So again, that's not a lot of companies have these salary issues, but those that are out there have to look at this and say, do I want to sit for 6 years without dividends? That's going to upset my shareholders if I'm in a position to pay dividends. And do I want to live with these compensation restrictions? So again, that's when the borrowers are looking at this and saying, is this a program I want to get into? That type of restriction is a concern from a borrower's perspective. Especially if you think you're going to, in a year or two, you're going to be back getting on all cylinders. You're going to be in a position to move forward. Now, obviously, you can repay the loans. You don't have to wait for the 5 years. But note that these restrictions on compensation and dividends continue for 12 months even after the loan is paid off. So there is a tail feature there to these restrictions that the borrower would have to comply with. Next slide, please. And this is the certification that both the borrower and the lender have to make. And basically, cutting through a lot of words, it basically means that neither the borrower or the lender is controlled by either the president, the vice president, the head of an executive department of the government, or a member of Congress, or their children. So if a bank has a major shareholder who is a member of Congress, the bank cannot make this certification. If the borrower has a major shareholder that is a member of Congress, the borrower might be able to make the certification, but both the lender and the borrower have to make it as part of the loan certifications that they're required to provide. So, and with that, I think that takes care of my presentation for today. Available for questions.
Thanks, Timothy. One of the questions that came in is, does the Fed's guidance provide any details on prohibited industries? Specifically, is an entity which provides credit products, such as a store credit card, but the entity is not a bank, eligible?
You'd have to go to the SBA rules. Like I said, there's 25 or 30 ineligible businesses under the SBA rules. That's where the rules come from. I know, for example, that loan companies and banks and bank holding companies are ineligible businesses. I believe other finance companies are ineligible businesses. I don't know about credit card companies, but that's just something. It's available on the SBA website. It's 15 or 20 page listing with with explanations of different things that you have to look at. And again, that's the borrower's responsibility. Like it was with the PPP program, the borrower has to determine whether or not they're eligible or ineligible, and the lender can just accept the borrower certification. But that's what you'd have to do to determine that.
The next question we received is, on the refinancing of other debt, could a borrower be permitted to use MSLP loan funds in a default scenario? Where this question is going is this is a situation whereby a borrower receives Main Street funds but defaults on other non-Main Street facility sometime in the future, and that defaulted facility is now accelerated and due in full. Is this accelerated debt now classified as due in normal course and eligible to be repaid with Main Street funds?
Well, you got to back up. Well, obviously money is fungible, so once you have the loan, it's where it goes is a different thing. It's the application process makes it clear that the company in bankruptcy or company facing bankruptcy. You recall we have the 90 certification that for at least 90 days you don't think you're going into bankruptcy. That sort of prohibits you from taking out the loan to start with. The priority loan can be used to pay off existing debt at the time you close the priority loan. And in fact, one of the provisions allow, as you recall, the amount of the loan that can be borrowed is the EBITDA minus the existing debt. When you make that calculation, if you're using a priority loan to pay off or refinance an existing loan, you don't include that amount of debt in that calculation because that's going to be paid off. But in terms of, once you've received the loan proceeds and then a year later the default arises, again, like money's fungible. I'm not sure there's any guidance specifically as to whether or not you could use the money or can't use the money to make those payments. But I mean, the money's there for operational purposes. The idea of the program is to use the money to fund your business, keep your employees employed, pay your vendors and things like this. So I would caution someone before going in there and doing that. But at that point in time, the whole business is probably going down the drain if you're being defaulted and loans are being accelerated and collateral is probably being taken. So at that point, you probably should seriously consider doing it, but do some research on that. I don't know for sure. Just on the face of the program, it's not what the program is designed to do.
Another question we received was, how does, or maybe it doesn't, the Main Street program account for operating leases relative to calculating debt? I'm asking in the context of recent lease standard changes that are slated to put most operating leases on the balance sheet as debt.
It's my understanding that they would not be included. But you really need to go into as I said, there's a 65-page FAQ that gets into the weeds on a lot of these things. I would think the leases would be okay. They're speaking about straight debt most of the time when they're talking about debt issues here, and that's just for purposes of obviously making the loan. But I would think that would be okay. But I would strongly suggest somebody go in and take a hard look at those. There are sections in the fact that deal with debt and calculation and things like this as to what happens, how that'll be treated.
And in terms of finding that information, you can either Google the Main Street Lending Program or approach the Federal Reserve's website, and the nice site with all the questions, answers, lending institutions, etc.
Yeah, it's bostonfed.org is their website. You just have to go in there and look around. There's a whole, and you'll find all the information. The FAQ I mentioned is also available at the Fed website, and a lot of the documentation, the term sheets for these various loan programs are also available at the Fed site. The Boston Fed site is easier to navigate, and they're focused on doing this. So I would suggest starting there first and looking for the FAQ. It's like it was just updated the 15th of July, so it's up to 80 pages now. So that'd be the place I'd start, just to get into the weeds on that as to whether or not those expenses count as debt.
Exactly. One question came about the PPP program. Have you heard if there will be another PPP program for business that are still not allowed to fully open but have already used up the PPP funds from prior rounds?
I have not heard that there's another program in place. And in fact, the rules are pretty clear that you can't get 2 PPP loans. You get the one you have. You can't go back in and ask for more money under the way it stands now. I've not heard any rumors that the government is considering set aside another $250 billion and starting another program. I mean, that can always happen. They're talking about a stimulus program right now, number 4 or something, $1 trillion or $2 trillion. So, but I don't know of I've not heard specifically of what you're mentioning. I don't know, TJ, if you've heard anything or.
Yeah, I was going to say the same thing. I have not heard anything in terms of another PPP program. And I was going to reiterate what Tim just said, is that it's pretty clear you only get one PPP loan. Now, with that said, Congress can obviously pass legislation at any point in time to change anything. So as COVID-19 drags on and the economy rebounds or doesn't rebound, all bets are off on that.
We've had situations where clients have gone in and didn't understand all the rules and borrowed money under the PPP program and discovered later that I could have gotten a lot more, but I miscalculated, and there's nothing they can do. They can't go back in and get a second loan. That's just it's a problem for, that the government has decided that that's the position they're taking on that.
Excellent. Any final thoughts, Timothy, before we wrap this up?
Well, other than, I'm just not sure this program is really going to move forward unless a lot more lenders get involved. With the 450 now, I know that there's borrowers out there who want to participate. First thing you got to do is you go to your own lender, see if they're going to be in the program. Odds are they're probably not, unless they're one of the major banks. And then if your bank is not going to be in the program, you've got to go find a bank. And like I said, there is a spot on the Boston Fed website where you can click on Illinois, and it'll give you a list of banks that are participating, looking for new customers specifically. Then you have to go to one of those banks. But like I said, there's only 7 listed right now. Hopefully that list will grow, and hopefully there'll be more than 450 lenders. But it's going to be a tough movement forward here without some momentum to push people. I think a lot of people have just decided that, like I said, the Goldilocks scenario. If I'm good and I can borrow money from the bank, why do I need this program? If I'm bad, I can't borrow money from the bank and I can't get in the program. So that's the forces pushing against each other at this point.
Okay, we had a question sneak in here before we wrapped up, so why don't we address it? Question is if you have PPP loan and elect to go longer than 8 weeks for forgiveness, can you apply for forgiveness at 12 weeks when you have enough payroll to forgive the entire balance, or do you have to wait until the 24 weeks are over?
Yeah, the answer is no. You can apply at 12 weeks if you want. The rules do require that when you apply for forgiveness, if it's prior to the end of that 24-week period, you essentially forfeit any of the other potential options in terms of, the full-time equivalents and rehiring people and all that stuff. It would be capped, and you would be stuck at whatever the the amounts were at the time that you applied for that forgiveness. But no, you do not have to wait for the full 24 weeks.
Excellent. Well, I think that winds us up today. I would like to thank TG and Timothy for a great presentation, as well as our audience for joining us today. So please remember to check RAEDC's website at www.rockfordil.com for business resources and upcoming webinars events. Have a great afternoon, everyone. Thank you.
Thank you.
Thank you.